Quick question before we get into it. When do you actually lose money in a bubble? Most people would say when it crashes, when the headline hits, when the stock's down 40% overnight, when your group chat starts sending panic memes. Wrong, completely wrong. You lose the money before that. You lose it at the moment right before the crash, the moment that doesn't feel dangerous at all. The moment that feels like a party. Everybody's up, everybody's posting their portfolio, and you're the only one asking, wait, does this actually make sense? I think we're standing in one of those moments right now, and by the end of this video, I'm going to show you exactly why, and more importantly, how to make sure you're not the one left holding the bag. Let's get into it. Here's where I want to start, because it's the detail that made me sit up. Over the past year, well over 600 current and former OpenAI employees have cashed out roughly $6.6 billion of their own private stock. Not options they were forced to exercise, not a mandatory sale, a choice. And they're not the only ones. SpaceX just went public. OpenAI is reportedly gearing up for an IPO, so is Anthropic. All three at valuations creeping toward, or past, $1 trillion. Three of the biggest names in the entire AI story, all racing for the public markets at basically the same time. Now, on its own, that's not a red flag. People who've worked at a company for a decade are allowed to buy a house. That's just being human. But here's the pattern worth knowing. Historically, when you see a cluster of big private companies all rushing to sell shares at the same moment, near what looks like the top of a boom, that timing has meant something. Research firms have flagged it before. It's not a rule, it's not a guarantee, but it's a pattern that keeps showing up right before things cool off. So ask yourself, if the people closest to the numbers are quietly heading for the door, who's walking in to take their seat? That's the question this whole video is built around. To understand why this moment is different, you need to understand something about how stock value actually works. It's a little bit of an illusion. Picture a company with 1 billion shares outstanding. One single buyer purchases one share at a higher price than the last trade. Just like that, every other share in the company gets marked up to match. On paper, the whole company just got more valuable. But did $1 trillion new dollars actually show up anywhere? No, nobody wrote a giant check. The wealth is really just belief, priced at the last trade. It's the same thing that happens on your street when one house sells for a shocking price and suddenly every home nearby is worth more, except nobody's mailbox got a check. For the last 3 years, that's basically been the AI trade. Belief, price targets, vibes, backed by real technology, sure, but the actual cash never had to show up. The story just had to keep being believed. That about to change, because once these IPOs land and once the data center build-out keeps scaling, this stops being a story people believe in and starts being a bill that real investors have to actually pay in real dollars, and that bill is enormous. Let's do quick math because the numbers are almost hard to say out loud. SpaceX, OpenAI, and Anthropic going public, that alone could pull in somewhere around $200 billion combined. Now stack the data center spending on top. For 2026, the major cloud players are projected to spend north of $700 billion in capital expenditure, combined. We're talking Amazon around $200 billion, Microsoft near $190 billion, Alphabet somewhere in the $175 to $185 billion range, Meta well over $100 billion, Oracle adding another $50 billion. Add it up, and you're staring down close to $1 trillion that has to come from somewhere, just to keep this machine running at its current pace. Here's the uncomfortable part. There's no secret vault of fresh cash waiting to fund this. For investors to buy that much new AI stock, they largely have to sell something else first. Apple, index funds, other tech names, to free up the cash. Which means the AI trade has gotten so big, it now has to cannibalize other parts of the market just to feed itself. That's not a rising tide lifting all boats. That's musical chairs, with a record number of people standing up and reaching for the same seat at the same time. Now here's where it gets clever, almost too clever. Nvidia invests billions into OpenAI. OpenAI turns around and commits huge sums to buy computing power from Oracle, AMD, and Amazon's cloud. What do those companies do with a chunk of that money? They buy chips from, you guessed it, Nvidia. The money goes in a circle, and every lap of that circle nudges valuations a little higher. Now, to be fair, the companies involved would tell you this is a virtuous circle, locking in scarce chips, scarce compute, scarce customers, all at once. And there's a real strategic case for that. But a closed loop that mostly pays itself can look exactly like booming outside demand for a long time, even after real demand from the outside world has quietly leveled off. The catch is, that loop eventually needs new money from outside the circle to keep spinning. And that's exactly what this wave of IPOs is. It's the circle reaching outside itself, asking regular investors, asking you, to step in and fund the next lap. This next part is the one that really got my attention, because it doesn't involve you making a bad decision. It involves the decision being made for you. Most people believe index funds are the safe, boring, grown-up move. Just buy the whole market, don't try to be a hero. Great advice. I've given it myself for years. But here's the thing people miss. An index isn't the market. It's a list. And that list is built and maintained by companies who compete with each other to stay relevant. Normally, a newly public company has to sit in season for months, sometimes close to a year, before it's allowed into a major index. Several major index providers just shortened that window. Nasdaq now fast-tracks huge new listings in as little as 15 trading days. The Russell 1000 and CRSP went further, as little as 5 trading days. That means a brand new, barely tested, wildly speculative stock could land inside your safe index fund almost immediately. Analysts estimate index funds alone could be forced to absorb close to a fifth of SpaceX's available public shares. Credit where it's due, S&P Dow Jones held the line and kept their full 12-month waiting period. Not everyone caved. But plenty of ordinary investors holding Nasdaq or Russell tracking funds have no idea this rule ever changed. You think you're buying stability. You might actually be buying the very top of the trade. Quick, honest detour here, because it matters. Investor Michael Burry, the guy who famously called the 2008 housing crash, has raised a specific accounting concern. When cloud companies buy billions in AI chips, they spread that cost out over 5 or 6 years on the books. But AI chips don't stay cutting edge that long, more like 2 or 3 years before the next generation makes them obsolete. If that's true, these companies could be understating their real costs, which makes profits look bigger than they actually are. Burry's estimate puts the potential overstatement in the tens of billions industry-wide, with certain names potentially overstating profit by 20% plus. To be clear, this is a thesis, not a proven fact. Plenty of smart people disagree. The revenue is real, the chips have real value, but you don't need Burry to be fully right. You just need him to be a little right for the ground under these valuations to be softer than the price suggests. AI is not a scam. It's not fake. It is absolutely going to change how we work and live. And that, weirdly, is exactly what makes this dangerous. The biggest bubbles in history weren't built on lies. The railroads really did connect the country. The internet really did change everything. People didn't stop believing in either, right up until the money got too expensive to keep flowing, and the late buyers, the ones who showed up at the very top, got wiped out. Being right about the technology has never been the same thing as being right about the price and the timing. So here's what I'm actually doing about it. Not predicting a crash, not shorting anything, not chasing the IPO hype either. Both of those are traps. Instead, 1. Check what's actually inside your index funds and how fast new stocks get added. 2. If you want AI exposure, choose it on purpose. Don't let a quiet rule change choose it for you. 3. Let new public companies prove themselves before you chase the price. 4. Keep costs low, keep your head clear, and remember, if you're the only cautious person in the room while everyone else is celebrating, that feeling isn't weakness. It's data. The riskiest moment never feels risky. That's the whole point. If you found this useful, subscribe. This channel is about staying 2 steps ahead, not chasing headlines after the fact. See you in the next one.